So traders, in today's video, I want to talk to you about the stock market and why I believe we are halfway there when it comes to the top in the markets. Well, I don't believe we're anywhere near the top yet, but I believe we're halfway there when it comes to the good old stock markets and when it comes compared to, like, say, 1929 bubble and the 2000 bubble. Let's get straight into it. Don't place a trade based on what you'll see in this video because there is no guarantees of making a profit in the market. It takes you a long time to become a good trader. So this video here is just to educate you to become a much better trader. Alrighty, traders, let's get straight into it. Guys, I'm giving away free membership access to my trading course. And I'm only going to do it for a very short period of time frame. So if you haven't done so yet, guys, free membership access. I normally charge $500, but you can see what's on the screen there. If you go to johnsfreegift.com, you can get free membership access today and start getting the help for free. Now let's have a look at the stock market here. I'll start with the technicals and then I'll get into some of the other stuff there as well too. Now looking at this, we're looking at the Dow Jones. The Dow Jones, on a technical basis, we are in continuing. There's the good old grammatically correct for you. We're good on the good old. my two brain cells are not working today. You know, I actually said that recently. I said it yesterday at a gym. I said to a guy, I said, my two brain cells are not working tonight, and he goes, "My half of my brain cells not working right now." Anyway, so low. We have a low, we have a high, we have a low, we have a rally up, and then we have a move through here. So as long as the line in the sand, technically basis, on the Dow Jones would be around this sort of 32,000 level, but also this sort of bit of a trend line here. We can actually see there's a bit of a trend line here on the Dow Jones. So this very long-term sort of so this sort of long-term trend line, but if I brought it back to here for a minute and brought it there, it's probably something through there, and now you can see we're starting to we did start to go up through there, as you can see. It was more like that there, that there, yeah, right there. So you can see we were above this here, but now we're broken through it, which has given us a bit of a what I call it resting phase, just a pullback phase. Because you can see when the market does go for a run, we generally, it goes for a run and stays above the trend line, and then we get a break. So if I go from here to here, if I draw from there to there, you can see how that we ran, and when we broke, we went sideways. If we go from there to, let's just remove that. If we go from here to here, as you can see, this trend line here, and then as we stayed above that trend line, then as we broke, we had a pullback, ran up, broke, pullback, and so on and so forth. And so you can see right now we're getting into the mix of a bit of a pullback, but I see this pullback being very short-lived before we start to go for another move to the to the upside. So right now, on a technical basis, right now we're getting a very good flattening period, and we're probably going to get a breakout and then a continued movement to the upside. Moving on now through to the S&P 500. And the S&P 500 has actually been a little bit more stronger than the Dow Jones. The Dow Jones is sort of flat, but you can see the S&P 500 is actually sort of slightly higher where we are now. So we may actually get a little bit of a pullback here on the stock market, but I don't actually see it being too much when it comes to this here right now. So we have this sort of a low point here, a high point here. You can see we have a slight higher, and this is where the market's talking to us, right? So we had this high here, slight higher, slide higher, or no, a good higher low, and then a breaking of this point through here. And as you can see, as it broke, that's when we actually started to make some nice moves to the upside, and we'll start to make that significant higher low through there. So very, 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 very nice higher low, and as you can see, it came down, broke out of that sort of this sort of downward move through here. You can see it had a nice sort of downward phase through there. And this nice pullback, and you can see sort of, and it's very, very fascinating when you start to look at sort of drawing your trend lines on these sort of movements. You can see here, it actually, on this pullback here, it actually rejected it once, rejected it, and as soon as we got back above this sort of pullback, you can see how it had a very, very, very nice move to the upside. And now we're just sort of going sideways. So if we did get a bit of a pullback, there's probably going to be here, but I don't see it being too much. I don't see it being a crash. And looking at now through the through the Nasdaq. And Nasdaq, once again, look at this here with the Nasdaq. This is where this is where, guys, when we're trading the markets, right, we need to always be watching what the market's doing. And so the market could be making higher lows and higher highs, and then something could start doing this, and then something could start to do that, and that, and that, right? So we need to just always be alert of where we're at. Just because it's doing this here right now doesn't mean it's going to do this, doesn't mean it's going to do this, and so on and so forth. So the purpose of me saying that, right, we actually started to have a bit of a downward move through here on the Nasdaq. Then we ran up, came back down, and as you can see, it found a bit of a higher low, and same sort of thing, as you can see, and this, you had this very nice sort of pullback, resistance there, resistance here, resistance here, resistance here, and now look what's happened. We actually had a bit of a pullback, and look at here, this point right here, look at that there, that was the point where it actually broke above this sort of trend line that was resisting, and that's actually a key point in the markets. So you can see rejected, 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 rejected. This here was a very, very, very key point in the market to where say that, okay, now that the tune is changing. We went from an overall move up to an overall move down. Now we're broken out of this trend line, and as you can see, and if I zoom in a bit more on this one, whoops, wrong button, John. if I zoom in on that one a bit more, let's just go through there to there. You'll be able to see once again. See how this market, see how it rejects it, right? So you can see it started the point there, it rejected it there, rejected it there, rejected it there. So for it to get not only get above it, but actually close above it, that's actually a very strong sign now that this overall move up, this overall move down is now likely to start to see at least a little bit of a movement to the upside on a short-term basis as well too. And you can see what has happened ever since through there, and now we're just where we are right now. So just again sideways with the Nasdaq. I do expect to see big things out of the tech sector. So that's what I'm seeing through there, guys, when it comes to the markets there. Now, guys, where we are right now when it comes to the stock market, there's so much liquidity out there in the markets right now. So I would not expect. I would say the explosion that we're seeing right now in the markets is halfway there when it comes to just type it in here, rate rise. Okay, so when it comes to the actual stock market, I believe we're halfway there when it comes to the top of the markets. I don't believe we're anywhere near the top of the markets. That doesn't mean we're not going to get crashes. We're not going to get pullbacks. We're not going to get corrections. We will get corrections. We will get pullbacks, just like you can see through here. But when it comes to the overall top in the markets, like the big picture, no, I don't believe we're there yet. I don't. For the next probably 12 months, maybe longer, we're probably likely to continue seeing some very nice, strong movements to the upside. And one of those big key indicators is the rate rises that actually happens with the Fed. Now, if you guys have listened, if you guys have watched or have read Ray Dalio's Big Debt Crisis. Actually, I need to read it again. Guys, it's one of those books that you need to just read probably 20 times, 30 times to really get in there. But one of the big key points that I get from Ray Dalio's Big Debt Crisis, which goes over all the major booms and bust cycles and so on and so forth, short-term debt cycles, long-term debt cycles, and so on and so forth, is the short-term debt cycle is very impacted by the rates. Obviously, also quantitative easing as well too, so printing of money. But there's a very big impact on what happens with the rates, right? So rates go down, asset prices go up. Rates go up, asset prices go down. And as you can see here, that when it comes to the 1929 crash, the Federal Reserve rate raised rates from 3.5% to 5% through 1928. So through all of 1928, guess what? They actually kept raising rates. And then the 6% in August 29. And then obviously, you know what actually happened in 1929, right? Then that's what actually pricked the bubble. So guys, I believe that that the government, when the government starts to raise interest rates, we're probably around about 12 months, as you can see here, right? So we started raising through 2008, we're probably around 12 months or so from the top. And as you can see, what was it? 2016 they raised rates through to 2017. Yeah, through 2017, they really didn't do much with the interest rates rise, and then what actually happens, and let me actually bring this up here now. Let's go to here, US Fed funds rate, and so as you can, let me actually show you this here because I think it's really important. So if I go to last sort of 5 years data, and I zoom in on this one here. Let's go 5 years. Yeah. So as you can see, they really started to ramp up interest rates here back in 2017, right? So 2017 into 2018 into 2019, they just kept slowly raising the interest rates when it comes to the stock market, and stuff like that. And then as you can see, that the Fed funds rate here, we did get a little bit of a pullback in the markets in 2018, but it wasn't the top. Look what happened, right? The interest rate kept going up, and then guess what? Then we had another catastrophe, another crisis, and all that sort of stuff as well too. So, guys, this is what's likely. And as you can, if I bring it back to a big long-term view, actually, let's go to Max here for a minute. You can see that what actually happens. So we go through a crisis, and they drop the rates, and then we start to get a bit of a boom in the markets. They raise rates, then it causes the next bubble to prick, and then it drops rates, and then that goes through the next crisis, and then they start to raise rates again, and then it pricks it, and then they go back down to here again, and then we have another crisis, and then they start to buoy the stock market, buoy assets, by having low interest rates, then high interest rates, then low interest rates, and so on and so forth. But you'll notice that every time we make lower highs and lower highs, they can't actually raise it to the levels in the previous, and that's what's actually called the long-term debt cycle, where we are right now, where massive defaults and tax increases and all that sort of stuff is likely to happen to actually start to pay back for this, and so on and so forth. Stuff that Ray Dalio talks about. So when we're looking at the stock market, and let's actually just bring this back up to here. When we're actually looking at this rate, as you can see, that's what actually happened with 2009, 2029. When we're looking at the big old stock market overall, so if I go to my all charts for a minute, actually no, let me just go to my main chart. So look at the S&P 500 from a big picture perspective. We may get pullbacks, and yes, we can get a bit of a pullback here. But remember, the line in the sand for the S&P 500, let me zoom into a 6-month view. The line in the sand in this last higher low. As long as the market stays above this higher low here, then the bulls are in control, and it's just a pullback in the markets, because you can see every single time the market has made a high low, we came down. Look at this here. We had a bit of a pullback, but where was the last significant low? Here. So we had a very nice rise. Then we had a decent pullback, but the market made what? A higher low to this here. These here are not higher lows. They must be significant in the markets. You can see came up, came down, 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 and so on and so forth. So you can see here higher low compared to this low. So yeah, we may actually get something like this for a few weeks in the markets, but then we're probably likely to do something like this, and then 2 months from now, the market's making very nice moves to the upside. So there we go, guys. I hope this helped you out. Let me know what you think in the chat box below. And I also when it comes to targets, I see a 40,000 Dow. Hope this helps you out, guys.